Good evening to all of you. Welcome to our class today. I think last time we met, we did introduce on financial management. We did make an introduction on financial management. Now, I am not so sure, okay, where we were. We admit someone here. Just give me a minute. Sharon. Sharon. Hey, Sharon is not in class. Trying to recall those who are in last time. Sharon? Yes, Claire.
Good evening. You had finished the introduction.
Yes.
We got up to earnings per share growth. And then you said for today we were to start agency.
Oh, agency theory.
Yes.
Okay, fair enough. We did an example on the earning per share.
Yes, we did an example. We did an illustration.
Okay. Thank you. Okay. Okay, that's good. Okay, then today then we start off with agency theory. Okay, on agency theory. Now, on agency theory, okay, the main idea or what we want to discuss in this topic is in a company. And if you remember, we say that when it comes to financial management, we take the perspective of a public listed company. Okay, we're not going to take the perspective of a family business. Okay, it is a public listed company. Companies whose shares have already been issued, already been offered to the public at the initial public offering. Okay. So in the case of the agency theory, in most cases, okay, shareholders, okay, for example, let's say the case of shareholder, okay, they do, for example, appoint managers, and these managers are meant to carry out some task, okay, on behalf of the shareholders. So, of course, these managers, they're going to be accounting, okay, to the shareholders at the end of the year. This is the company gave us. These were the asset you gave us, okay? The asset gave us were worth 100 million, for example, okay? There is a amount of profit this particular asset have been able to make for you. This is by how much the asset have grown by this particular time period. So in most cases, okay, there'll be what we call the managers, for example, and the shareholder, whereas the managers are acting as the agent of the shareholder, for example, okay? So in this topic, we want to discuss what are some of the unique agency relationship that exists in a firm, okay? One of them we have just mentioned, shareholders and the managers, where in this case, the shareholders are the principal. They are the one who do, in quotes, control this relationship, okay? And we do have the agent, in this case, the managers being the agent. They are the one who are going to be accounting, okay? They are the one who are going to be making decisions that are in line not with their own objective, but towards the objective of the shareholders, okay? So they are the agents, okay? So we shall discuss what are some of the unique agency relationship that can exist in a firm, okay? And could there be some potential conflicts that can exist between the agent and the principal? Could there be some instances where maybe the agent, okay, don't forget you said the agent is meant to take a decision, is meant to make a decision that are meant to, let me admit some people here. The agent is meant to make some decisions that are meant to increase, for example, the wealth of shareholder, in this case, the managers. But could there be some instance where the managers are going to make their own decisions that don't benefit the shareholder, but they benefit the managers themselves, okay? Forget the managers are paid money, okay? They're paid money in order to increase the wealth of shareholder. So in case the managers will take any action, any decision that is going to go contrary to that, then we have to call an agency conflict, okay? That's what we are discussing this particular topic, okay? What are some of the conflicts, okay, that can arise between the different agency relationship, okay? And in case, for example, you are a shareholder, okay, you need to foresee. This is some of the problems that might occur. Now, what do I do as a shareholder? What do I do as the owner of the business? in order to protect myself against some of these problems, okay, what call solution. You try to see what can I do, okay, as a shareholder in order to mitigate the impact of these problems, okay. So that's what we'll be discussing in this particular topic, okay. Okay, so go save the topic. And as mentioned, that the agency is going to arise, okay, where we have two parties, okay. We have what we call the principal and you have what we call the agent, okay. You have the principal and you have the agent, okay. As I mentioned, what is the key distinction or what distinguishes the two parties, okay? The agent, don't forget, is appointed. The agent is going to be appointed by the principal, and the agent is meant to ensure that they do that all the different activities, okay, that the principal was meant to carry out, making decision. For example, they are passed on to this particular person. The decision-making power, okay, is passed on to this particular person, to this particular, in this case, the agent, okay. And the principal, generally, how do we know that this person is a principal? The one who is going to be controlling this relationship, the one who is going to be mandating on what is meant to be achieved, okay? The one who is going to be appointing the agent by default is going to be the principal. And the one who owns the resource, in quotes, okay? The one who owns the resource owner is going to be what's called the principal, okay? Definitely, therefore, don't forget, I think you did in law, you must have done that. If, for example, the agent they make some decision, okay, or rather, the agent a decision, okay, that they do make, okay, they can in a way be used against the principal, okay. If the agent, for example, okay, was to make poor decision, okay, or make illegal decision, then maybe sometimes they can have a case where they can be personally be held liable, but also the company can also be held liable, okay. For example, the decision made by the directors, for example, okay. So don't forget, it is the action that the agent does take, okay, they can also be binding on the company, okay. Yes, as the principal, okay, as the one who owns the resource, okay, you have to foresee could there be some chances that maybe this person appointed, maybe the managers that I've appointed, okay, they might make decisions that go against my interest as the owner of the business. Could there be a chance that that might happen? It's you as the owner of the business, it's you as the principal, it's you as the resource owner to foresee some of this problem, okay? So what are some of the conflicts that can occur in my business? What can I do, okay, in order to ensure that I avoid, not even, if not possible to avoid, you reduce, okay, the potential impact of these potential conflicts that can occur, okay? What we call the agency problem, okay? We refer to as, in this case, the agency problem, okay? So foresee some of them, okay? If we are the shareholder of the business, could there be some decisions that managers can make that are going to hurt us, okay? That are going to go against our interests, okay? You need to foresee some of these problems, okay? And you put measures to address that problem, okay? Now, there are three main types of agency leadership that can exist, okay? However, I'll only discuss two of them, okay? We have the first being shareholders versus manager, okay? We have shareholder versus bondholder. Can have shareholder versus shareholders and managers, okay? This should be shareholders and managers, okay? Versus the government, okay? There are three major types of agency relationship that can exist, okay? Shareholders versus managers, shareholders versus bondholders, shareholders and manager versus the government, okay? So we shall begin the first one, shareholders versus the managers, shareholders versus the managers, okay? Now, in the case of shareholders versus manager, okay, in the case of shareholders versus the manager, we say that the shareholders are the owners of the business, okay? They are the resource owner, okay? They are the one who own the company. And of course, since in most cases, they cannot be the one who shall be managing their business, okay? We mentioned that we take the perspective of a public listed company. It implies, therefore, as shareholder, you're going to be appointing other parties to run your company. In this case, the managers, okay? Which means, therefore, as you do appoint the managers, don't forget the managers are meant to be accounting to you as a shareholder. That this is how the firm of this, we as the managers, okay, we are going to be, for example, our interest, or rather, our objective is to pursue your objective as a shareholder, and you as a resource owner, okay, which implies therefore the shareholders, of course, therefore, they are going to be the principal, okay, and the managers, they're going to be the agent, okay. And the question is, why therefore would the shareholder want to appoint managers? Why can't they themselves run their business, okay, to avoid all these potential agency problems, okay? The number of reasons, okay, why this can happen, where the shareholders, okay, may not run their own business, okay, they're going to be having someone else, okay, to come and run their business, okay. One of the key reasons is that in most cases, shareholders, okay, they do lack what we call the technical expertise, okay. They lack the experience, they lack the expertise, okay, that is needed in order to run a company effectively, okay. So it's not always a guarantee, okay, that you being the owner of the business, you do know how to run the business, okay. It's not always a guarantee, okay. So in some cases, they may be requiring expertise, okay, in certain areas. So since you may not, okay, not all the case, but since you may not be able to run a business well, why don't you appoint someone else who would have that technical expertise, someone who has the experience, okay, that can be that you can use, okay, in order to run your company effectively, okay. Then also sometimes in the case of example, the case of PLC, okay, the public listed company, we have said that you may be you also too many of you, okay. If you take for example the percentage of small example Safaricom, how many individual shareholders as well as corporates does it have? Okay? They can run to the hundreds of thousands. So in case all of you want to become managers, you can imagine the chaos you can have with the company. You are too many of you, okay? You cannot run all of you your own business, okay? You are too many of you. You cannot all be managers, okay? So in that case, therefore, you may have to appoint agents, okay, who are going to be therefore to be running your business, okay? Why? Because then you are too many of you. You can't all of you in quote, okay, be in the same roof, okay? Then you have to work the time constraint, okay? Sometimes you can have cases where these shareholders, okay, they don't just own this business, okay? They have more business that they trade. They have their own other day-to-day job which they do need to run, which implies therefore, since they might be constrained in terms of time.
We can't hear you, sir. I think you've muted yourself.
Oh, I had muted myself. Whoa, all that time. For how long have this been?
Okay, just so first of all, you went, the screen went off, and then after like some few minutes, it came back, but you're not talking.
Wow. Okay. 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 Thank you. Now, where did I stop? Where did you hear me last? Which point?
Was the shareholders versus the management.
So all these points you didn't hear me discussing. All these 4 points.
No.
Lack of technical skills.
Technical skills. That's where I stopped. Wow.
Yes.
Okay. Thank you. Wow. Sorry for that. Okay, so I was discussing on time constraint. Wow, it's too bad that I've been discussing on my own. Anyway, the time constraint is one of the factors you may want to consider. And time constraint is an element where you as shareholder, okay, you may be having other businesses, okay, where you may be involved in, okay. You may be, for example, not being stationed in one particular area, okay, you have some other business that you want to run, would imply therefore the time that your business that requires of you to dedicate, you may not be able to dedicate that time that your business do require, okay. So if that's the case, therefore, what do? Of course, you have to get someone else who is going to be running, someone else going to be able to dedicate the time required in order to run a business effectively. So in that case, therefore, as shareholder, you may have therefore to be to appoint therefore the managers, okay? Because your time constraint, you don't have enough time to be able to run your business well, okay? In the case of geographical dispersed, okay, we are saying that in most cases, shareholders are going to be in different locations altogether, okay? Some can be in Kenya, some can be in Tanzania, some can be maybe in UK, which imply therefore, if that is the case, therefore, there's no way that all of you are going to be on the same location, on the same central location where you can be able to run your company effectively, okay? You can't run a company well through Skype. That can happen through Zoom, okay? It might not be a very effective way, okay? You do need some time to be on the ground, okay? So in case most of you are going to be dispersed all over, they imply therefore, okay, to have all of you in the same location will be very hard. You can't be able to run your company effectively. So what do? Get someone else who's going to be on the company, someone else who's going to be in the company, actually, not on the company, in the company, okay, running the company well, okay? So therefore, in that case, therefore, you may be forced, okay, to get a representative, or to get maybe, or one of you, for example, okay, to be acting as the manager of your business, okay. Now, all these factors, therefore, they do imply, therefore, okay, that as shareholder, you do need to, therefore, to appoint managers. You do need to appoint agents, okay, that are going to be running your company, okay. However, don't forget, you appoint managers, you do appoint these agents, okay, with the aim of ensuring that the objective you form the firm for, okay. Why do you form this firm, okay? To maximize my wealth, to increase my profit, okay. So that is what the agent are meant to pursue. They are meant to pursue your interest as the shareholder. But it's not always a guarantee, okay, that they're going to be pursuing your interest as the owner of the business. They may end up as an area where they do pursue their own interest, okay. And that's if that's going to happen, then we have an agency problem arising, okay. We have an agency problem arising, okay. Therefore, as shareholder, get to know what are some of these conflicts, what are some of the source of the potential agency problems that can occur, okay. And of course, we put in measures that are meant to mitigate the impact of these problems. We put in measure solutions, okay, that can be able to use to reduce the negative impact of this diversion, okay, of our interest and the interest of the management, for example, okay. Some of the problems, okay, or some of the agency problems that can arise because of the following factors, okay. One of them is called referred to as the motivation problem, okay. Now, what does that imply? If, for example, you do one of the objectives you have, okay, is to maximize your profit, okay. That's an objective that you want to maximize your profit over a given time period, okay, between beginning of year 2021 and end of year 2020 and the end of year 2020, we do want to achieve a profit, an increase in profit of from 10 million to 20 million. It's a good objective, definitely, okay, because you're there to make money. However, don't forget, okay, if the managers do not partake of the gains, do not partake of the good performance of the company, then they may lack that motivation. Okay, what do we in quote? Okay, the element of self-interest comes in. What do I have to gain as a manager if I achieve this objective? Okay, what do you have? What is my take here? Okay, so that might come in here. Okay, so you're the first shareholder. You may want to see, how can we incorporate, how can we be able to assist the managers, okay, to become part and parcel of our good performance, okay? So see for sure, okay, that if we do pay our managers a fixed salary, okay, now, if the aim of the business, last year the profit we made was 10 million, this year the target is 20 million, okay, it's true that the manager should pursue your interest, but what do they have, what is going to be their gain, okay, because it is an element of human person, okay, that they're going to be saying, what do I gain from this transaction? Okay, they'll be saying that I want to increase the profit. After I get the profit, what extra? Okay, what is going to be my takeaway? Okay, so as a shareholder, for example, we're going to discuss one of the methods we can do, or one of the what you can do to motivate the managers is they become partakers of the good performance. Okay, you can tell them that if you do beat the target, okay, the target is to get a profit of 20 million. If the profit is more than 20 million, then every extra profit you make over and above the target, we are going to be sharing with you as managers. For example, 80%, 20%. 8% comes to me as shareholder, and you as manager, you take the extra 20%. Of course, by default, therefore, they're going to be motivated to work even harder, okay, so that they can beat the targets. And they know that in case they do beat the target, they're going to be sharing, they'll be in quote money into their pockets, okay? That's one of the problems that you may have to see. And therefore, shareholder trying to see, what can I do in order to resolve the problem, okay? Then you have the consumption of high perquisites. Perquisite is just, is like the pay, okay? The general term for the pay, okay? Or the court is referred to as the perks, okay? What do the manager take home, okay? What do they take home? Now, in case, for example, okay, the problem when it comes to the consumption of high salaries, consumption of high bonuses, okay, consumption of high salaries that the managers maybe wanting and actually actualizing it, the problem could be, don't forget, okay, that the expense, the pay that you make the managers, okay, in itself is part of the expense side, okay, which implies therefore, if it is increasing, that means therefore your profit is decreasing, or the profit increment is going to be reducing because of these high salaries that the managers are paying themselves, okay. Now this could occur, okay, in a case where the managers are the one who dictate how much they're going to be paid, for example, okay. And if the company, in most cases, in most PLC, okay, in the most of publicly listed company, okay, managers, the pay to the managers is dictated by who? But who dictates the pay to the managers? In the case of PLC, publicly listed company, who decides that the managers, the CEO is getting paid X amount of money? The CFO is getting paid X amount of money. Who made that decision for most of the top managers in the company? Yes, Lillian.
The board of directors.
It's going to be the board of directors. Thank you, Lillian. It's going to be the board of directors who make that decision. Now, if, for example, the managers and the board, for example, have you seen a scenario where the chairman of the board is also the CEO? I don't know whether they've seen that other case where the chairman of the board is also the CEO of the company. Have you ever seen that such companies?
Yes.
I hope yes, because most times you can have a scenario where the chairman of the board is also the CEO of the company. Now, that is a poor corporate governance structure in place. Don't forget, if the CEO of the board, if the CEO of the company is also the chairman of the board, what does it imply? He is one who is going to be giving direction on what the board is meant to be doing. Which implies therefore, if you're the chairman of the board, of course, one of the key agenda you'll be having, you may end up having, okay, not saying that can happen, but it may end up having is a discussion, for example, on the pay that you're going to be making, okay, which implies therefore you're going to be directing the board, hey, you as a board, don't forget, I'm also the chairman of this board, okay, I'm one who is going to be indicating the agenda of the meeting of the board, okay. So that case where they have case of the day-to-day management, okay, having power over the board, then that can be one of poor corporate governance structures in place, okay. And of course, they may end up having a case where they do overpay themselves, okay. Okay, it can occur in a scenario where the board is overrun by the management, okay, the day-to-day management. Okay, so it's a sign of a poor corporate governance structures the firm be having. That should not happen. The chairman of the board should be different from the CEO. Should be a distinct. It should be two different persons, okay, from the CEO of the firm. Okay. Then you have the case of what we call difference in risk profile. Okay. Now, what does this mean? Okay, risk profile. In most cases, okay, shareholders, we normally say that in finance theory, we say shareholders are risk-averse persons. Okay, they are risk-averse investors. What does risk averseness imply? When you say that shareholders are risk-averse, what does it mean? Okay, risk aversion. What does it mean? The shareholders are risk-averse. Yes. Is someone who had an idea? Yes, Immaculate.
You can say that the shareholders are less likely to take up investments that involve a high risk.
Okay, shareholders, they shy away from investment that will expose them to high risk. Okay, it's an element. I agree. It's one of the part of risk aversion. Okay, the shareholders, as much as possible, they again be avoiding taking up investment that have high risk exposure. Okay, it's one of the part. I agree. Okay, to some extent, it's true, but the risk aversion is another element of risk aversion. Someone else have an idea on risk aversion? Okay, the other element of risk aversion is that, Lillian, again, Lillian.
Yes, they will only take high risk investments when they are promised a high return.
Yes, I agree. Thank you, Lina, for that. Is that the shareholders, okay, or a risk-averse investor is or can take up an extra risk if, okay, there's going to be a compensating return. Okay, they can take risk. By the way, it doesn't mean that when you say someone is going to be risk-averse that they don't take up risk. They can take up risk. However, there must be a promise of a higher return. Okay, so they can assume risk. However, there must be a promise of higher returns. Okay, they're called by risk aversion. So generally, shareholders, we assume that they are risk averse. Okay, they're risk averse. When they do want to make investment, okay, when they do want to take up investment, what first they want is that the shareholder, do they want high returns or they want high low returns? Okay, that is a question. Definitely, they want to get high returns, but do they want to assume risk? Do the shareholders want to assume risk? Shareholders, they are willing to invest, or generally, they do want to invest in high return yielding projects. So the question is, do they want a risk that comes with those high returns projects?
No.
Of course, they don't want, okay? Of course, the shareholders, they don't want to assume that risk, okay? So when it comes, for example, giving targets to the managers, okay, giving targets to the management, of course, they agree that this is the amount of return we want to achieve. However, in finance theory, we do see that we have what we call a risk return trade-off theory, okay? I mentioned it later on. The risk return trade-off theory, risk, we'll write down. Okay, it's called the risk return, okay, trade-off theory, which applies in reality. Is that at the end of the day, okay, in case you want to get high return, then you must be willing to assume the high risk that comes with that investment. Quite unlikely are you going to find a case where we have a case where the returns are high, the risks are low. Quite unlikely. In conventional assets, okay, okay, you'll be having the returns, the assets that do give high returns also comes with high risk, okay. For shareholder, they want to high returns, but they don't want the risk. Okay, that's a problem. Now the manager that I had, okay, the manager that I had, okay, if, for example, the shareholder, in quotes, they put excessive pressure to the manager, you must get this high return, okay, then for sure the managers, they don't have an option. They're going to be investing in high returns assets, but those assets will come with high risk. Okay, you can see that there's an issue. If anything, if the project was to fail, if the projects of the company were to fail, who bears the risk of those assets? If you invest in an asset in a company, assume that company A buys company B, okay, and now the company they have bought or the asset they have bought, okay, is let's say it's closed off, okay. What's the best time to use here, okay? That's this particular asset, okay. You bought shares of, let's say, bought shares of Safaricom, okay. In 3 months' time, the Safaricom shares maybe they are listed, okay. They are no trading in the stock market. Who bears the risk? Is it the manager or the shareholder? Who bears the risk that the company is getting closer? Sharon.
The shareholder.
The shareholder. Yes, you are the one. You are the owner of the business. You are the one who therefore is going to be bearing the entire risk. Okay. If this investment collapses, it's you to bear the loss that comes to that investment. But don't forget, for shareholder, for the managers, since they don't partake of these losses, okay. By the way, can manager partake of the gains? The managers, don't forget, if the company collapses, the managers, they don't bear the risk of company collapsing. But if the company becomes well off, okay, can a manager partake of the gains of the company? You got a question, okay, but hopefully you all got a question. A case where the managers of the company, if the company was closed down, they don't bear that risk, okay, that one is for sure, okay. But if the company does well, can the manager partake of that good performance of the company? Sharon?
I think they will, because maybe they'll try to negotiate some benefits with the shareholders.
That's what we're going to have most of. Yeah, I agree. Thank you, Sharon. Is that in most cases, the managers are going to have what called performance-based contract. That in case, for example, the company does really well, then of course they gain be partaking of those high gains. Okay, like the way I just mentioned, the case of motivation, where the company can have a target. You want to achieve a profit of 10 million, for example. Any extra, they can be sharing with you. What if the company make losses? What if the company was to make losses? Do they share of the losses of the company? They don't. Okay, so we can have a risk attitude. Okay, we can have an attitude of the manager where they, in quote, they I don't care attitude, in quote. Okay, I don't care. If let me invest this money. If the investment becomes well off, of course I'll be gaining. If it doesn't do well, then I don't have any risk. I'll be bearing. Okay, that's called a difference in risk profile. Shareholder, they want high return, but they don't want to assume risk. Okay. And for any investment that yields high return, it comes with high risk. Okay, the money that I had, if the company performs well, I gain for sure. Something good for me. If the investment fails, I don't partake of the losses. Okay, that's the issue. Therefore, you may have a conflict between the two parties, the managers and of course the shareholder. Okay. I hope that's all clear. Okay. Then you have a core difference in investment evaluation horizon. Okay. In most cases, the top management of the company, are they given a fixed term contracts, or are they given what term to use here? The top managers of the company, are they employed on contract basis, or are they given fixed employment terms? The top manager of the company. An example, the CEO. Let's take the case of the CEO.
Contracts.
They're given contracts, okay, that generally would come the top management, they're given contracts, okay, that we want to hire you as our CEO for the next 5 years, then you can review your performance, okay, and if you're going to have achieved what we had agreed upon, then we can renew your contract therefore, okay. Now that implies therefore, as a manager, therefore, if my contract is going to mature in 5 years' time, okay, will I take an investment whose returns will be received in 10 years' time, or will I invest in a project whose return will be received within my contract period? Which one do you take? And Sharon?
A project that will be within my term.
Yes, of course, that's going to happen is that the managers, you're going to be investing in projects that are going to mature within your contract period, within, for example, those 5 years. For shareholder, don't forget, are they there for the short term? The shareholder, we assume that these are shareholders, these are investors, they're not speculators. So they're going to be investing in this business for the long term, okay? For the next 10 years, for the next 20 years, for the next 100 years, okay? That's what they want to invest their money in, okay? However, for the case of the managers, they will ensure, let's invest in a project that again maturing when my contract is being mature. Because if I invest in a project that again have a life of, let's say, 20 years, then the cash flow, the potential return from this investment is beyond my contract period. Which implies, therefore, I won't be able to show the shareholder, this is the project I've made, this is the returns I've been able to receive, because the return received is beyond my contract period. Okay. Therefore, the renewal in quote, okay, of my contract is going to be the returns. You maybe have a scenario where the shareholder might not renew your contract because the returns to be received are beyond your contract period. The investment deed is going to be, it has a longer period of time. Okay. The difference in the investment evaluation horizon, okay, where the managers may end up investing in short-term projects, but shareholder, they want investment that goes beyond the life of the contract period of the managers, for sure, okay. Then have got the pursuit of power and self-esteem goals, okay. Now this may occur a scenario where the managers may want to take up investment, okay, that those investments, they're not meant to increase the shareholders' wealth. Those investments are there to, in quote, let's say, pamper, okay, the ego of the managers. For example, we have cases where company, they do invest in private jets, okay? Company, they do invest in private jets, okay? They have what called the pet projects, okay? So you may want the question, by the time that we take this investment, the key question that the managers ought to ask themselves, is it going to increase the wealth of shareholder? But in some cases, some investment the managers take, they don't at all increase the wealth of shareholder. They are purely meant to pamper, they're purely meant to show the ego of the managers. In that case, therefore, the in itself, it goes against the objective of the shareholder. Okay, those investment, those projects, okay, they go against the shareholders' wealth acquisition. Why? Because they are only there to for the self-esteem of the managers, not for the shareholder, but for the managers themselves. Okay. In the case of what we call creative accounting, or what we call account manipulation. Okay. Yes. Okay. Creative accounting or account manipulation. Okay. Account manipulation. Okay. Now, what those occur is that you can have cases where there'll be what we call misstatements, okay, that the company make a loss of 10 million. However, we as the manager, we are the one who prepares the accounts of the company. We know that in case that we don't achieve this target, we are agreed upon, if we are going to report a loss within that particular year, then shareholders will not be happy with us, okay? They may have even firing us, for example. Now, of course, the managers, since they're the one who do decide, okay, on the accounting policies. For example, okay, over how many years should we depreciate this asset? Who makes that decision? It is a manager who makes the decision. Okay, if should we depreciate this asset over 2 years or over 10 years? Okay, it is a manager who made that decision. Okay, so if, for example, they have a case where the managers want to reduce the expenses, they want to, for example, reduce the depreciation expense. Okay, so they can give the asset a longer life than what it deserves. Okay. We are meant to depreciate the asset over 2 years life. However, we increase from 2 years to 10 years. Why? Because we want to reduce the depreciation amount that appears on the profit and loss account. Okay, don't forget that's the account manipulation. You can be reporting a figure that, in essence, okay, you didn't achieve. You're going to be representing figures that are already misstated. Okay, there's account manipulation. You report a profit, whereas you didn't make a loss. Okay, you're going to be reporting a higher asset value than what the company deserves to report. Okay, that kind of you as a shareholder, you're going to be consuming information that is misstated. You're going to be happy that the company has made a profit. In reality, you have not made a profit. If anything, you've made a loss. Okay. Now, all those are problems, okay, that can occur, okay, that can be between the shareholders and the managers. Okay, and as I mentioned, you as shareholder, you are the owner of the business, so you need to have foreseen what are some of these problems that might occur. What do I do in order to reduce the negative impact of these problems? What can I do to ensure that I, in quote, remove these obstacles, okay, that are impeding us and the managers, for example. Okay. All clear? Any addition that we may be having? Or a question you may be having on that area? Yes, Sharon.
Kindly repeat on the point difference in investment evaluation horizon.
Okay. We said in most cases you're going to having the managers are going to be employed on contract basis. Okay. For example, the manager can maybe have been employed in the year 2017, and the contract had the contract then was for 5 years. So you apply that for in the year 2022. That's when the manager is going to be, the contract can be renewed, okay, based on how he has performed over the past 5 years, from 2017 all the way to the year 2022. Okay. Now, if, for example, I'm a manager and I know that I'm here, for example, to achieve the goal, the target, you can say that generally, as a manager, they'll be taking investment that will be maturing in the next, for example, 2 years. Because my contract renewal is subject to how have I performed in the last 5 years. Okay. If the shareholder, therefore, will take up that, they will be assessing myself, me as a manager, they can be assessing me based on the last 5 years. I'll ensure that I'll be investing in projects that will be giving returns to the shareholder within those 5 years, isn't it?
Yeah.
And a shareholder, which implies that if you're going to be investing in 5-year projects, now what happens to the company's survival after those 5 years? It is not going to be guaranteed. Shareholder, on the hand, when it comes to making decisions as where to invest our money, we want to have a company going beyond those 5 years, going beyond the year 2022. Okay, however, for managers, you're going to be investing in projects, for example, that matures in the year 2022. What about beyond that? Okay, there's no guarantee to the shareholder because the investment you took matures in the year 2022. Okay, you can see there's a conflict there. Okay, shareholders want to invest long term. You as a manager want to invest within your contract period.
Okay, thank you.
Okay. Now, you shareholder, of course, as I mentioned, it's you to foresee some of these problems. Okay, you need to foresee all this problem. Okay, try to see what can we do in order to ensure we reduce the potential, the negative impact from the problems that are there. Okay, one of them, for example, you can have what we call performance-based contract. Okay, or called performance-based contract. Okay, paying the managers based on how the company is performing. Okay, but of course you have to be quite careful. Okay, that you don't give an accounting measure. Okay, when it comes to assessing how the company has performed. Okay, so if, for example, you're going to be paying them based on how the share is performing, that's something good. You tell the managers based on how you're going to be paying you bonuses, not in terms of the profit you've made. Okay, or even you can have the case of profit. Okay, assuming that this person will be honest. Okay, that you're going to pay you if you achieve the target of 20 million we had agreed upon, then any extra profit you make over and above the 20 million, we are going to be sharing it with you. Okay, so they're going to give you contracts that are based on the pay or the bonus you're paying you is based on you achieving the target. Okay, it is based on you performing. Okay, or performance-based contract. However, sometimes you can have a dysfunctional behavior that occurs at the end of the day, because in case, for example, the pay is based on profit, and the managers have the power to decide or to manipulate the accounts of the company, okay, to misstate the accounts of the company, then they can be persuaded, okay, to misstate the accounts of the company. Why? Because they know that in case we report higher figure than what we do deserve, you're getting paid. Okay, so as you try to structure how you pay the managers, be careful. Okay, the targets they ought to achieve should not be within their power. Okay, that's the quote. Okay, it should not be within their power. Otherwise, they're going to be miststating the accounts of the company so that you think as shareholder they have done quite well. In reality, they have not done anything. Okay, so as you do give them performance-based contract, be careful. Okay, that they cannot manipulate the targets that you want to assess them on. Okay. Then you have, of course, the case of threat of firing. Okay, threat of firing. Okay, it can occur that scenario where you tell the managers, hey, if you don't achieve the target you agreed upon, then we are not going to, for example, renew your contract. Okay, the way you just mentioned. Okay, where the shareholder say that we are not going to renew your contract only if you're going to have achieved what it agreed upon. Okay, a threat of firing. Okay. We mentioned the case of corporate governance. Okay, as I mentioned, one of the simplest way of trying to have good corporate governance, ensure the chairman of the board of director is distinct from the CEO of the company. Okay, that's one of the way you can try to structure in good corporate governance, ensuring that the CEO is not the chairman of the board. Okay, and also the board should have more called the NEDs, okay, the non-executive directors. They should be more of the NEDs, okay, not the executive, okay, not the employees of the firm, not the manager, the day-to-day manager of the firm, okay. They should have more of the NEDs, the non-executive directors, okay, not the other way around, okay. So if, for example, the board is made of 5 people or 10 people, ensure that at least 20% of those members, 7 out of the 10, are non-executive, okay? They're not involved in the day-to-day management of the firm, okay? Then you have the case of threat of hostile takeover, okay? What does that mean? Well, that implies that company, of course, they acquire the company, okay? We have KCB, for example, acquiring SNL, okay, Saving Lending Corporation, okay? What others? We have acquisition in Kenya. We have, okay, that was a merger. We have CBA and NIC. That was more of mergers, not a merger as opposed to being an acquisition, okay? I'm trying to see a recent acquisition that has occurred in the market.
What about National Bank and KCB?
National Bank and KCB. KCB was meant to come and rescue National Bank. Was it an acquisition, as per se? If I remember very well, what happened was KCB was coming, tried to rescue National Bank as opposed to acquiring it. And I don't think it was more acquisition. Anyway, I can't remember exactly what the structure was. But let's assume that that was the case, that we have now KCB coming over and acquiring, okay, acquiring National Bank, okay. Now, is that a case where I have KCB coming over and acquiring National Bank? First of all, why is National Bank being acquired? Is it because it's doing well or it's doing poorly? Just a question. Is it doing well or doing poorly?
It was doing poorly.
Of course, doing poorly, which implies, therefore, we as KCB, once we take over National Bank, what is going to be a first thing that shall do? Let's first of all, who is the one who is going to be if the company is doing well, okay, who do we say is the one who is performing well? Are they the employees or the management of the company?
The management.
What's the management? Okay, it is the management who is doing well. What do you mean if the company is doing poorly, who is going to be blamed in quote? Of course, the management also. Okay, so we as, for example, KCB, once we acquire National Bank, what shall we do first? What will give the first order of the day?
Change the management.
Is game we are going to change the management, therefore, okay, which implies, therefore, we as shareholder, we can in quote inform the management that, hey, you guys, if you don't achieve our target, if our company is doing poorly, then the first thing we're going to do is that we're going to sell our company to someone else who would want to buy us out, okay, which implies, therefore, what we're telling them in the management is that, hey, if you don't achieve our targets, then of course you're the one who you as we suffer, you're going to be suffering, because that implies, therefore, your job is going to also be at stake. A threat of hostile takeover. Okay, you're in quote threatening the management that, hey, if you don't achieve this target, okay, we are going to be selling off our company, okay, in a hostile way. Okay, so you're the one who once we do sell our company, of course, you as a manager also, you're going to in quotes also lose your job. Okay. Then you have got the case of the executive share option plan. Okay, a share option plan. What happens is that you do give the manager an option of, for example, buying your shares. Okay, we as shareholder of Safaricom, we are going to give you shares as a board of director, or you as our deputy management. We want you to become shareholders in the business. We want you to become co-owners in our business. Okay, so instead of giving you bonus in cash, you're going to give you bonus, for example, based on our shares. So you're going to give you shares, for example, at a price of, let's say, shillings. Let me use shillings, okay? Currently, our share for Safaricom is going for, let's say, 6.5, okay? So you're going to buy our shares. You have the option to buy our shares in the year 2025, for example, okay, at a price of 26.5, okay? So you're going to give them option, not today, okay? It is going to be in future. So they can buy those shares, not today, but in future, okay? Now, what is happening? Moses, you have a question maybe before I continue?
John?
Yes, Moses?
On the hostile takeover? Hello?
Yes, Moses, can I hear you?
On the hostile takeover?
Yes.
When the company is sold, does the management change?
That's what I'm trying to say, that if, for example, where are you selling your company, okay? And let me say the case of, you know, there was a company that was called CMC. You all know there's a company that was called CMC. Yes. Is it still
Alfutain.
Yeah?
It was sold to the Alfutain Madrid.
Yes, it was sold. Once that transaction is over, once the company is acquired by someone else, and the company was doing poorly, we have seen that who is the one we blame that you are the one who didn't achieve well, you didn't do well? It is the management. That you as a management, you're the one who you're the one who was not doing well, you're not taking your task well. So the question is that once now the company, CMC, get acquired by this Arab company, who is going to be fired first? Because it's you as a management, okay? Because you're the one who didn't unlock the company's value. The company is making losses because of your poor decision, okay? So the first person who is going to be shown though is going to be the management before you're the employees of the company, okay? In short, the case of the threat of hostile takeover, we are trying to tell the management that if you don't achieve a target, then you're going to be selling our company without your approval, okay? In the case of the normal acquisition, the management in quote have to approve that particular takeover, that acquisition. In the case of a wholesale takeover, you're going to bypass the management. So the management quote not know, okay, that they are going to sell off a company, okay. So the first, therefore, once the company get acquired, the first person who's going therefore to be shown the door is going to be the management, okay. We are trying to threaten them that if you don't achieve this target, then you're going to sell your company without your approvals as the managers. Okay.
Okay, thank you.
Then you have to call the case of a share option plan. Okay, let me go with the case of Safaricom. So we are shareholder in the year 2020. In the year 2020, we give an option. You're going to buy our shares, okay, for example, at a price of 26.5. Not today, but in the year 2025. Okay. Now you as money, therefore, we are not going to give you these shares for free. We are giving the option of becoming a shareholder by buying the shares from us, okay, at a future date. Okay. Now, how can you therefore, you as manager, maximize the value of the option? If, for example, in the year 2025, the share price then will be, for example, 50 shilling, okay, an example. It implies, therefore, you as manager, you're going to buy from us the share at 26.5, not at 50, the market price then, but at 26.5. So therefore, you as manager, the way you can maximize the value of your option we have given you is by ensuring the share price increase further than 26.5. If it goes to 100, the better off for you as manager because you're going to buy the share at 26.5, but their value is 100. So as you attempt to increase the market price, okay, from 26.5, you're also increasing our wealth as the shareholder. You're also increasing our value of our shares. Okay. In short, you're going to be tying down the interest of the managers to your interest as the shareholder. Okay, making sure that the manager becomes part and parcel of the company ownership. Okay, so as they pursue their interest of increasing the share price further and further, the more value you also get as shareholder, but the share price is also increasing. Sharon?
And what if the share price reduce? What happens?
It can occur, the share price is going to reduce. Of course, definitely the managers, of course, they're not, don't forget, in the case of this is an option, not an obligation. So the managers may not want to buy the share because they don't make any gain. Okay. So if the share price is going to be reducing, then of course the managers will not buy those shares. But of course, don't forget, they want to pursue their interest. And what's their interest is to gain from this option as much as possible. So they're going to make a decision, or the main purpose of giving them option is to ensure the decision they're going to make, okay, are geared towards the share price increasing, okay. But it's not a guarantee the share price is going to increase, okay. It can also decrease, but if the share price don't increase, of course, since they're also going to be they're going to be what's time to use here, okay. Since they're also wealth maximizers, they are not going to buy. If the market price then is, let's say, 20, of course they want to buy them, okay, because the market price is much more lower than what they can buy them at, okay.
Okay.
Because this is an option, not an obligation, okay.
Oh, it's an option because it's something that is being done in future, so that is why I wanted to understand.
Okay. Because the case of the share option plans, okay. And of course, we have the case of contracting the cost. Okay, one of them is contracting costs. Of course, as you design the contract, you want to ensure that as you design the contract, that you want to tie down the interest of the managers and the interest of the shareholder to be what to call it. There's no that friction. Okay, so as you do, you hire lawyers who are going to assist you in designing very good contracts. Okay. Of course, in case you're going to, the more advanced company is, of course, the better contracts they're going therefore to be designing. But to design a good contract that again tie down the interest of the managers to your interest is not so easy. Of course, you have to pay lawyers who are going, for example, try to see all the different loopholes available. Okay, try to see that you're going to tie down the manager's interest to your interest well. Okay, and of course, you have the case of monetary cost. This is more towards the audit, for example. Okay. Of course, you do hire the auditors, okay? You don't need to hire the auditors. We're going to go through your financial statement, try to see, could there be any potential misstatement on those financial statements, okay? If there are misstatements that the managers have committed, then of course the auditor is meant to highlight it, that, hey, the accounts of the company have been misstated. You need to correct those financial statements. So you can hire all those auditors. We're going to be going through the accounts of the company to see that there is no any misstatements. Okay. In this case, more to reduce the chance of account manipulation. Okay. There's some case you can have a case of the cost of restructuring. Okay, the cost of restructuring. So in case, for example, the company bought there's some pet projects that the managers did invest in the previous years. Okay, and now we are in the year 2020. You can decide. We are struggling right now, okay? So why do we need this private jet? We don't need it. Dispose it off, therefore, okay? Restructure, okay? In some cases, as you restructure, you may be selling off some of your departments, some of your projects, okay? Some of your investment at some losses, okay? But you want to structure because you don't make it again as shareholder, okay? Because the cost of restructuring. Okay, try to look for auctioneers to sell off your company, to sell off your investment that don't add value. Okay, the cost you've been carrying as you attempt to restructure, you're called restructuring cost. Then sometimes you have to bear the loss as shareholder. Sometimes, not always the case, but do sometime. Okay, you may have to bear on the losses. Okay, as you try as much as possible to tie down your interest and the interest of the managers. Okay, you may have to buy in some cases bear that loss, bear that cost. Okay, so the loss that you buy, you do bear. Even if you try as much as possible, that's going to be given. You cannot at any point in time be willing be tying down the interest of managers 100% to your interest. That can happen. Okay, so if you are shareholder, the idea is that try to reduce this residual loss to as much as possible, even though it cannot be at 0%. Okay. Then, of course, at the AGM, you as shareholder, you need to have your voice. What's happening here? Pardon me, I seem to have some issues with my network here. You can hear me?
Yes, sir.
Yes, sir.
Okay, thank you. Now, one of the ways is that at the AGM, you as shareholder, of course, you can sponsor, in quote, a motion of the AGM. If you think our company is not being managed well, and you have an idea, at the AGM, of course, you can have your voice heard. Okay, sponsor a motion at that point in time. If you think the company is not being managed well because the board is operating in cahoots with the day-to-day management, okay, you think that the board is being overrun by the management. Of course, sponsors try to see what can we do in order to protect that. So at the AGM, you can sponsor a motion. Okay. Then make recommendation, for example, on how the company, you think the company can be run well. Okay, you can do that at the AGM. You as shareholder, you can do that. Okay? So all these are ways that you can try to assist, okay, to elevate the problems, the areas problems that can occur. Okay. Any question? Okay, seems that it's all clear to all of you. Okay, so as you can see so far, okay, if the question is going to be asked by your examiner, then the exam is going to be more or less to be directing you to, okay, to is this be the whole theory question. As I mentioned, don't forget in your exam you'll be having like maybe 70% calculation and 30% discursive question. Okay, and this is kind of one of the discursive questions, the 30% of the marks in your main exam. Okay. I hope you know how to access the Kasna past paper. You do know how to access them. Joseph, you know how to access them? You don't know?
No.
Now, let me. So the question will be found on the Kasna website. Do provide some of these questions that you can use. Okay. However, they're not so not what I would want. So, but for the time being, we can use them. Okay. So let me try to check on the Kasna. Let me try to project my Google Chrome here and project to just show you how to access them. So, okay, you can see my browser. If you just search on, for example, Kasna past paper, okay, for example, I hope that they're still there. The last time I checked they were there, okay, Kasna past paper. Okay, you can see Kasna past paper. Where was this? You can see library, you can see this, okay, the library.kasna.or.ke, okay. So the last time I checked, there were questions there. So past exam papers, there is the Kasna website. So past examination paper. Okay, you can see CPA. Okay, so the papers are from 2015. You can see that they are from 2015 to 2019, 2015 to 2019. If, for example, I open 2015, let me open this one, 2015 November. Okay, so financial management. Okay, so you can see that all these questions are here. So financial management, let me open this one. Okay, and you have here financial management. Okay, this for the November 2015. Okay, so for the time being, this is what shall be using. Okay, for revision in class. However, I'll see whether it is possible for us to get other paper from the from the other sittings. Okay, because the more questions, the better off we're going. The more questions we have at our disposal, the better off it will be asked for us to understand the examiner well. Okay. So, like for example, okay, so this is how the exam will be more or less like. So I'm trying to see whether there's a question that we can attempt to answer right now. Okay, from this sitting, seems there's none we can answer for now. Yeah, this is a question that you can answer here, like the earning per share here. Like in this example, okay, in question 3, the following information is to this company, you're meant to require the earning per share. Okay, anyway, let's first finish the topic, then shall come back to we attempt some of these questions that we can be able to discuss. This one, 3A, we can answer for sure. Okay. So that's example will be, okay, some bit of the question will be asking you, for example, this question 1A is asking you highlight 3 financial instruments that are traded in the money market. Okay, so there's some question that will be asking you to They are discussive. Some question will be asking you to do calculation. But as I mentioned, it will be like 70%, 70% calculation and 30% discussive question. Okay. And we shall come back later on. Okay. But you know how to access them now. Okay. So ensure that you do download all this question. Okay. From the CASNEB website. Okay. So you'll see from my link here, library.casneb.or.ke/past papers. Okay, so all these past papers, you can access them on that particular platform. Okay, I'll see a way of trying to get more questions from the past, okay, 2014 going downward. Okay, the more questions, as I mentioned, we have, the better it will be for us to do the revision. Okay, let's go back to our notes. Okay, so that was on shareholders versus the shareholders versus the management. Then you have, of course, shareholders versus board holders. Okay, shareholders versus board holders. Okay. Okay, the board holders are those debt capital providers. Okay, the debt capital providers of the company. Okay, and in this case, in the case of the debt holders, okay, we have the debt holder. As I mentioned in the beginning, we have the case where the one who owns the resource, okay, the one who owns the resource is the one who owns the resource, okay, the one who is going to be giving his money, okay, is one more or less going to be the one in control, okay, as per se, therefore, he is going to be the principal, okay, and the person who is going to be in quote, take that money, manage it, and give a report at the end of the day on how, for example, he used that money, is the agent, okay. In this case, therefore, who is the principal and who is agent? You have been using that as our point of argument. Pardon me, my internet is a bit erratic. Okay, that's what's going to be. Okay, as I was asking, okay, between the shareholders and now the board holders, who is the principal? Yes, Daniel.
I think the bondholders are the principal.
Of course, thank you, Daniel. Don't forget, the bondholders are going to be the principal. They are the one who own the debt capital, okay? They are the one who own the debt capital, okay? Which implies, therefore, you as the managers, okay? You as the shareholders, of course, you as also the managers, okay? Shareholder and the managers, okay? You are the one who will be accounting, okay, to this principal, to this debt holder, on how you have used your money, okay? On how you have used your money, okay? So essentially, therefore, the shareholders are going to be the agent, and the debt holders or the debt capital providers are going to be the agent, okay? So of course, therefore, you as the debt holder, you are the one who will be having the problem, okay? You are the one who will be having, therefore, the agency problem, okay? So therefore, for C, okay, what can we do in order to improve our situation, okay? But generally, by the time you give up your money, of course, you have considered what type of borrower, what type of company are we going to be investing our money in, okay? Because if you consider, for example, okay, the company as a structure, okay? In short, what we mean by that is that of the company assets, okay, what composition is the long term, okay, what composition is short term, okay, what is current, what is uncurrent. If, for example, you do have more of current assets than the non-current assets, would you be concerned, by the way? Would you be concerned? If you have a scenario where the company wants to borrow money from you, okay, through the bonds or through even the case of the long-term bank loans, okay, and they have more of current assets than the non-current asset, would you be concerned? You got my question? Now we all got my question.
Kindly repeat the question.
If you have a company, you are a final debt capital provider, okay? Let's say, okay, case of any financial institution, this is the case of a bank, okay? If you have here a borrower who wants to borrow from you a loan that matures in 10 years time, okay? So this loan is going to mature in 10 years time, okay? If in their asset structure, okay, they have more of current assets than current assets, would you be concerned that the borrower, the company want to borrow from you, they have more of current than non-current? Would you be concerned?
Yes.
Yes, I think I will.
Okay, why?
Because the non-current assets, as we saw, it's something that can be easily liquidated. So they're in a position to, okay, they're in a position to like quicker than the long-term, the long-term assets. Yeah, and then the non-current assets, you are able to acquire. For example, if it's a land, you're able to acquire its title deed or something, unlike the others.
Okay. Thank you. Of course, that's a game reason. But essentially, in case you can be the debt holder, you can be concerned because this company wants to take my money in court for the next 10 years. Okay. Now, what if maybe at the end of year 5, this company does not, at the end of the 5, the company defaults? Do I have the asset? Can I be able to go and in court take up this asset and repay myself? Okay. Can I be able to, can that happen? If the company had more of current, by the time the year 5 comes in, those assets are already gone because they were current. Okay, they were not non-current. Okay, but implying therefore you may not be able to repay yourself fully. Okay, for the amount that they owed you. Okay, the assets structure of the company. Okay, and of course, what do you expect in the future? Not just what is existing, but also what is going to be expected. Okay, in some years to come, for example. The factor you may want to consider, for example, of course, is what we call the gearing of the firm. The gearing of the firm. Okay. So currently, this company, how much debt does it have? They want to borrow from me, but already, how much debt they have already? If they have a huge debt level already, and they want to borrow more from me, of course, you'll be concerned, okay, because they may, like this company have too much obligation. They have too much payments they need to make, okay, which imply therefore you're going to be in court, okay, throwing yourself into the fire, okay. So therefore, as a company, as debt provider, you'll be concerned on the company gearing level. How much debt does this company has? Okay, if it's too high, then of course that implies therefore high risk. Okay, you'll be taken up in case you can be the debt provider. Okay. Then, of course, as I mentioned, okay, in this case, the shareholders are the agent, okay, and of course, the holder are going the principal, okay, shareholders, the bonds, the providers, the bondholder are the principal in this case, therefore, okay. The issue comes in case where the action the shareholders take, okay, the issue will come in if the action the shareholders take, okay, will be reducing the wealth of the debt holder, your wealth, your investment as a debt holder, okay, that's what we have, therefore, a conflict arising, okay, case where the shareholder, once they make a decision, it is going to have a negative impact on your wealth, okay. Now, those are some of the things that to be concerned as an investor. Of course, your main concern is that what's the value, the market value of my investment in this company. Okay, any action that are going to decrease the market value, okay, they're going to decrease the market value. Of course, it's going to be a conflict between yourself and the shareholder. Okay. Now the question is, okay, what might decrease the market value? In short, what might increase the risk? What might increase your risk exposure? Okay, you as a debt holder, what action can shareholders take that are going to be increasing your risk exposure? Okay, and the foreign action might increase your risk, and by default, decrease your market value of your investment. Okay. One of them is the disposal of assets that are used as collateral. Okay, the disposal of assets that are used as a collateral. Now, this is going to happen in most cases. Okay, you can have a case where maybe out of trust, okay, the bank gave you money without them requesting, okay, to have the asset. Okay, it can happen. Okay. Now, if, for example, the asset, okay, the company did some of the assets, okay, some all of the debt holder or the bond holder, they can request the company provide us with some of provide us with an asset, okay, that in case, for example, in the case of failure of you paying us the interest, in the case of you defaulting, then we do have a fallback, okay. Now the asset that is provided, okay, as a fallback, just in case we don't pay you money, is referred to as security, okay, referred to as security or the collateral, okay. Now, what if, okay, we did not transfer the legal ownership of this security to our name as the bank, as the debt holder, and you as a company, you go ahead and dispose of this particular asset before the loan matures, before the end of the life of the loan, before you have paid us a whole amount? What that implies that you're going to have a case where you as the debt holder, you have a high exposure towards the risk, okay? Why? Because the asset you had a fallback to is not there. It doesn't exist. The company disposed that asset 2 years ago, okay? That's going to happen most of the time in the case of what we call the floating charge, okay? What referred to as the floating charge. What's a floating charge, by the way? What's a floating charge? And how different is it from what we call a fixed charge? Floating charge and a fixed charge. What's the difference?
Hello.
Yes.
I think a floating charge cannot. It can be adjusted.
It can be adjusted. What do you mean by that, Robert?
Maybe if the market is good, it can be brought up, while if it is not good, it can be lowered. Yes.
Okay. Thank you for the idea. Okay. Thank you, Robert, for the idea.
Thank you. Welcome.
We also have another idea on the difference, floating charge and a fixed charge. Okay. The difference between the floating charge and a fixed charge is on the asset that have been used as a collateral. If the asset that have been used as a collateral are what we call moving stock or moving assets, in the case of inventory, in the case of receivable, okay, if that is what has been used, okay, as the collateral, as the security, then we say that that loan was a floating charge. It was a floating charge, okay. There's a security, okay. There is a collateral that has been used against that debt. However, if it is what we call moving assets, okay, assets that today will be there, tomorrow will be not be there. In quote, they're moving literally, okay. So if the debt was secured against those assets, then we refer to that debt as a floating charge debt. If the debt was based on fixed assets of the company, okay, on the case of the non-current assets of the company, then we call it as a fixed charge. Now the problem with the floating charge is where, don't forget, since the assets are moving, maybe by the time the company default on paying you, the assets are there, the time you gave the loan won't be there, okay, that as I mentioned. The assets have already been sold off, and that's kind of for the key problem when it comes to the floating charge debt, okay. So in case of a fixed charge debt, okay, don't forget you have a fixed asset, okay, that has been used as a collateral. So it will be there this year, and next year it ought to be there definitely, because this is an non-current asset. It's not going to be the moving stock of the company, okay. So the concern is going to be more towards the floating charge of the company, a floating charge debt, okay, where the asset can be there today and tomorrow they have already been disposed of, okay. That's going to be therefore the main concern we'll be having as a debt holder. What type of asset have you used as a collateral? Is a fixed charge? Is a floating charge? If it is a floating charge, then you have a higher risk, okay. Then you have the case of what we call the asset substitution. Okay, the case of asset substitution. Okay. Question? Okay. So you have a case of called the asset or investment substitution. What happens is that for every person who's going to be providing with debt capital, of course they're going to be asking, even in case of normal bank loan, okay, you want to make an investment, the bank is going to be asking you, where do you want to invest your money in? Okay, you're going to be as the borrower, you're going to invest in the money in this particular project, A, B, or C. Okay, now what happens in case, for example, we have a case where we do have the best time to use that once you get the money, okay, that once you get the money, you as a borrower, there could be, is there a chance that maybe you're going to use it? Let me unmute some people. Okay. Could there be a chance that once you get the money, okay, that once you get the money, you as the borrower, you may invest in other investment? Can that occur? You took the loan, you said, I will invest the money in, I don't know, this hotel business. But once you get the money, you may end up investing in some high-end vehicles. Can that happen? The money is used for something else other than what was intended for. Can that happen?
Yes.
And of course, can happen. A scenario where the investment that you did set in the contract will be different from what you actually go ahead and invest. Now the problem comes in, okay, where now the risk exposure to the provider of debt is much more higher than what you had agreed, okay? The risk of the investment that you've taken now, the new investment after you took the money, is greater than what you agreed upon with the debt provider, okay? Of course, there's a problem for sure, okay? Now you have a case of what we call high payment of dividend, okay? What does this mean, high payment of dividends? If a company do pay dividends, okay, you as a holder, okay, you may, the interest, of course, you get paid the interest before the dividend, okay? Why? Because you rank higher than shareholder, okay? Something good that you rank higher than shareholder. However, once you get paid the interest, for example, in the year 2019, what remains, the shareholder can decide we're going to pay ourselves all that money as dividend. Okay, you showed you don't have, you may not have a say, okay, on what they do with what remains. Why? Because they have paid the interest. Okay. However, the concern could be next year in the year 2020, if the company were to make losses, and last year they paid all their earnings as dividend, can they have the cash? Can they have the money to pay the interest? The company may not have the money because last year they made a huge distribution of the earnings to themselves as dividend. Therefore, you as the holder, you have a higher risk exposure that in future the company may not have enough cash to pay you the interest. Okay. Now the concern we're having is what we call other investment. Okay, just like the substitution, this where the company is going to have a case where they invest less than what you agreed. How much money have we given you? We have given you 10 million. How much money do you end up actually investing? 3 million. What happened to 7 million? You ate the money in court. Okay. Now that's therefore a concern. Now other investment is getting more of concern if the interest payment to the company, to the bank, for example, is based on the return on the investment. Okay. That the interest we pay to the bank is pegged on the returns on the investment, which implies therefore if you are invest the money, what does it mean? It means therefore the return to the bank, the interest payment to the bank is going to be put at a jeopardy. Why? Because you did not invest all the money that you're given by the bank, the debt provider. Okay? Now, of course, that's an issue because the return is not going to be guaranteed because you did invest less than what you had agreed upon or the money you were given at the beginning. Other investment. Okay. And the problem is going to, for example, the borrowing of more debt capital. Borrowing of more debt capital. Okay. Now, the beginning it might not be a huge problem, okay, but as time goes by, in case there'll be more debt capital providers that comes after you, okay, of course, you as a first in quote debt holder, you rank before the other debt holder, okay, of course, because you came first in quote, okay, so you rank before the other debt holders, okay. However, don't forget, once you get paid your interest, the other debt holder need to pay their interest. Okay, and of course, the subsequent payment of the interest is going to be draining the company's cash. Okay, the subsequent payment of interest and the principal to the other debt holder that runs after you is going to be draining the company's cash. In the future, if the company is making losses, that imply therefore the company reserves have already been reduced by the previous year's higher payment of the interest and the principal from all the different debt holders. So an increase in debt capital, therefore, indicates a reduction in the company's reserves, a reduction in the company's cash, which means that in future, the company's chance of paying the interest and the principal is decreasing. Okay, which implies that you as debt holder, you're going therefore to be exposed therefore to a higher risk. Okay. Therefore, those are some of the conflicts, some of the problems, okay, that can occur between the debt holders and the shareholder. Immaculate ask.
Could you kindly repeat the asset investment substitution?
Okay.
Yeah, thank you.
For example, we are already in the case of personal loans, okay? Let's take the case of the personal loans, okay? Now, where the bank, once they give you money to the borrower, okay, once the money, you do go to the bank, for example, you submit what called like a proposal, okay, that you're going to take this money and this is our investment. You're going to invest in project A, B, and C, for example, okay. Now the question is there a guarantee that once you get the money into your hands, you as a borrower, you're going to actually invest in what you're going to propose? There's a chance that might not happen, that you may end up investing in some other projects. Now the problem comes in is that the risk of that other investment you have chosen to take is higher than what you had agreed upon. You took money to invest in a business, but that you didn't take the business, you didn't invest in the business. If anything, you bought your own personal car. It's an investment you made. However, what's the risk now to the bank? The risk to the bank is much more higher. Okay, because now the returns, the bank, when they were giving you money, they did assume a certain risk. But in case you're going to be expose them to an extra risk that implies therefore they're going to be assuming a higher risk than what they were willing to accept. Okay, and the problem comes in. Okay, let me just repeat a scenario where the return to be paid to the bank is pegged on the return on the investment. So in case, for example, the return, the interest was paid on the business starting up, which you never did start in the first place. You invest in a personal vehicle, for example. Is the bank going to get its interest? Of course not. Okay, because this is a personal vehicle. It won't be bringing any cash. Okay, in that case, therefore, okay, which implies therefore the return to the bank, the interest to the bank is put in high jeopardy, in high risk of not being paid. Do you get the point?
Yeah, thank you.
So therefore, as you said, of course, you as the debt holder, you are the one whose money is put at a risk. Therefore, see these problems, you need to have foreseen some of these problems, okay? Try to see what measures can we put in place, therefore, to address these problems, okay? Therefore, you need to put what solutions, see in advance, what are some of these problems, okay? What can we do, therefore, as the debt holders, okay? One of the means you can try to put in place to address the problem would have been called covenants that are restrictive. Contracts, okay? These are covenants or agreement or contracts, okay, that are quite restrictive on the side of the borrower, okay? One of the ways they can restrict is on no disposal of assets without the permission from you, okay? That if the company, if for example, you can agree, if for example it was a floating charge, okay, you can agree that the amount of money given is how much? 10 million. Okay, what's the value of your inventory? What's the value of your stock? Okay, it is 15 million. Okay, so you can agree that hey, if your asset, if your inventory at any point in time goes below 10 million, then you need to inform us if we are your provider of capital, then inform us. Okay, if you're going to have any further disposal of those inventory, then you do require our explicit permission. Okay, for example, in the case of the movie stock. Okay, if the company is going to having the movie stock, you can have an agreement that ensure that inventory of your stock should not go below a certain amount, for example. Okay. Then you have a case where, for example, an agreement of no payment of dividend. Okay, what that implies that as the holder, okay, the company you're going to give money to, okay, within, for example, the next 5 years, they should not pay themselves in dividend. Why do you want to impose this restriction? Is because you want to conserve the company retained earnings. Okay, you don't want to have a case where, as a company, the company pays too much dividend to an extent that the company has no cash flow in future. Okay, you want to ensure that the company don't pay dividend so that the company cash reserves are going to be maintained. Okay, that in the future the company, even if the company make losses, they still have money. They can still be able to pay you the interest. Okay, so you can restrict that in the next 5 years, as long as I'll be your debt holder, you can't pay yourself any dividend. Okay, you can put that as one of the condition, one of the agreement between yourself and the debt holder. Okay, then you have a case where the company gearing, the company debt capital is not going to exceed a certain ratio. For example, you can agree that once we give you money, your gearing will be, for example, 10%. If you are to obtain more debt capital, then first of all, you need to pay us the money. Okay, that can be one condition. Okay, if you want to get more debt, your debt is going to increase about 10% from what it is currently, then you need to first pay us money. If you want to borrow money, we don't have a problem, but first pay us our due. First repay us our money. Okay, or it can be you have an agreement that your gearing is not going to exceed 20%. Okay, so you can borrow money. Okay, as a company. Right now, your debt is 10%. By 10% mean, therefore, that for every asset you bought, 10% of your money came from us as the debt holders. 90 came from the equity shareholder. So in case you want to borrow money, you can borrow more money, provided it doesn't go beyond, for example, 20%. If the debt goes beyond that, then this is going to happen. Okay, you can have, for example, a provision or a call provision. If you don't pay us money, then you get, if you exit the foreign agreement, if you contravene the foreign agreements, then you're going to be asking you to fully pay us the money on call provision. Okay, that's called a call provision. Okay, that in case you don't adhere to this agreement, then you're going to force you to call the bond. By calling means you're going to pay us our money. Okay, you can have that as part of the contract you can have. If you pay yourself dividend more than what you agreed upon, then you're going to be forced. You'll be forcing us to force you to pay us our money. Okay, or we can call a call provision within the bond, within the contracts. Okay. Then you have the case of the transfer of assets. That can be something else. Okay. Of course, in case you fear that the assets they use as collateral are going to be disposed, what can you do? And this is going to happen in most of the banks, for example. Okay, they're going to be asking you, this particular asset, okay, this motor vehicle is what is you're using as a collateral. Then transfer the legal ownership from yourself to us as a bank. Okay, transfer the title deed. Okay, let's have the title deed. Okay, let's have the logbook. Okay, we transfer the ownership. Okay, from yourself to us. What does that? How does it have does that help? Okay, of course it may ensure that you do not dispose. Okay, that ensure that there is no any subsequent disposal of the assets. Okay, why? Because we have the title deed, we have the logbook. Okay, so that we are able to secure any potential disposal of that asset. Of course, you can have a case where you'll be asking, having a party, part of the board being our appointee. Okay, how does that help? Having the board having one of the director, you are the one who appoint them. Okay, how does that help? Of course, that ensure that there will be no any decision that goes against your interest as the debt holder in the board discussion. All the discussion made by the board, you are aware of them. Okay. So that makes it easy for you to be able to track the decisions that are made by the company. Are those decisions going to go against your interest as the debt holder? Okay, that's why you do need someone to be sitting on the board. Okay, they can help you out. Okay, of course that will occur in case the amount of money you give to the company is too much. Okay, too much in quote, that you fear losing your money. Okay, so you can tell the company, you want this money, good. However, I'll have to have someone sitting on your board. Okay, it can happen, for example. Okay, for example, the case of Uchumi, there's an instance, I think there was a case of the likes of KCB. Okay, they were sitting on the board of Uchumi, although Uchumi owed them too much money. Okay, to an extent, actually, they were asking them, Uchumi was forced to ask them, we can't pay you your money. Okay, what happens? Convert your money to equity, or the conversion clause. Okay, so what happens is that in that case, therefore, you instead of continue being a debt holder, you become an equity shareholder. Okay. you're going to be given shares. You give up your bonds, and in case therefore you become a shareholder within the company. Okay, how we call a conversion clause in the company. Now, how does it help you as a debt holder? Having a conversion clause, you become an equity shareholder. Okay, so definitely once you become an equity shareholder, you can now be able to vote at the AGM. Don't forget, as a debt holder, you can't vote at the company AGM. Okay, however, once you become a shareholder, you can now be able to vote at the AGM. Okay, you can now be able, for example, kick out managers. Okay, if you think that the person who is delaying the company's progress, the person who is becoming an obstacle, okay, is a manager, you can force a motion. Let's kick out this particular manager. No, you can't do that in case you are a debt holder. You don't have that power. Okay, the conversion clause gives you the chance of being able to exercise the sum of the power which are not available to you as the debt holder. Okay. Then last but not least, you can refuse to lend money. Last year, this company borrowed money. They have never paid back the money. Why would you want to pay them money? Why would you want to give them more money? If they have no, if there's some contract, they have some loans, they have never adhered to. Some of the terms they don't adhere to. Why would you want to give them more money? So you can refuse to lend the money. Okay. Now, all these are some of the solutions, mechanisms that you can put in place, you as the debt holder, in order to protect yourself against any chance that your money, your finance, your investment might be hurt. Okay. Don't get you the principle. Your money is one that has take care. Okay. So the case of the shareholder government. Okay. Now this one I will not discuss. Okay. So I'll leave you to discuss this. Okay. It's a short one, but it's another agency you can have shareholders versus the government. Okay. But the two common. Okay. That's what I wanted to discuss was shareholders versus manager, shareholder versus the debt holder. Okay. Question? Okay. I see to be no question. Joseph?
So far I'm okay.
Yeah, you're okay. Okay, fair enough. We can take a break then.
All right.
Okay, less than 7:22, then we can take a 15 minutes break. We meet at 7:37 then.
Fantastic.
Okay, fair enough. Let's see you then.